everybody. Today is Thursday, June 17th, and I'd like to welcome you to this week's installment of C-Suite Snacks. I'm Steve Ronan, the leader of Citrin Cooperman's consulting and outsourcing practices and the host of today's webinar. The economy is active right now, and this recovery means that many businesses are growing quickly again, but have also undergone fundamental changes to how they manage their business, how they finance themselves, and how they use their financial information to make strategic decisions. Combine this with a uniquely tight talent market, where getting the right accounting talent in the right seats is increasingly difficult. And you have a situation where many CEOs and CFOs are turning to new ways of running their finance and accounting function, either by transforming how they work, implementing new technology, or sometimes outsourcing. Today, I'm joined by Jason Slivka, Citrin Cooperman's Executive Vice President of Strategic Initiatives, and we will be discussing ways to assess the best path forward for finance at your company. Should you build it, buy it, something in between? Today, we're going to explore that. As always, we ask you to submit questions throughout the webinar, so please locate the Q&A button on your Zoom screen and feel free to enter questions there as we go. We'll save time at the end of today's presentation to address any that we receive. We will also be doing our weekly snack basket giveaway, where one lucky attendee from today's session will win a craft basket of snacks. The winner will be announced at the end of today's session. Finally, if you're here because you found this session on our website or on social media, I encourage you to sign up for our mailing list to make sure you receive an invite for our new snack-sized topics each week. Please also visit our C-Suite Snacks Content Hub on the Citrin Cooperman website to view the recordings and look through the decks of prior presentations. You already know me. I'm Steve Ronan, and today I'm joined by Jason Slivka.
Hi, everyone. I'm Jason Slivka, Executive Vice President, Citrin Cooperman, based in our New York City headquarters. Play two roles at the firm. First, as a corporate development executive working on M&A deals for the firm itself, and second, as a leader in our outsourcing practice along with Steve.
So when we think about finance excellence, we think about it across four dimensions. The first is strategic. Can you use your business results, your forecasts, budgets, and actuals information to provide outstanding decision support to management? The second is talent. As I mentioned earlier, it's putting the right people in the right places within the right culture in finance and accounting to advise on those strategic decisions and make sure that all of the data is accurate, relevant, and timely. The third area that we think about is process. How do we achieve high velocity, highly efficient and reliable processes across the accounting function? And from a technology perspective, are we using technology in a forward-thinking way that's driving efficiency in operations and helping us innovate as we go? So that's really the framing for thinking about, do I have an outstanding finance and accounting function or not, right? How am I doing in each of those four dimensions? And ultimately, what finance should be doing for any company is helping drive the strategy forward. And the way that finance will do that is through decision support. And decision support breaks down generally in three different categories. First is understanding what's happened and why. This is your traditional accounting and bookkeeping function, where you're keeping track of the numbers on an ongoing basis. You're understanding how the company has performed, and we're understanding what, at a given point in time, how it compares to performance in the past. So, if you get monthly financial statements, that's an example of this type of decision support. Monthly cash flow, your balance sheets, anything that's kind of looking at financial information in arrears is what that first level of decision support is. Most companies have this in place, and at some level at least, right? The next maturity milestone is understanding what's happening right now and why is it happening. So it's moving from that monthly cadence to more of a cadence that's aligned with the business cycle that you're in. If you've been in a company that has TV screens up in the finance department, in the sales department, and operations with dashboards that are updating KPIs or key performance indicators and certain metrics throughout the day or throughout the week, that's an example of this type of decision support. If you're moving to do weekly closes and weekly flash reports on how the business is actually performing, that's also an example of that higher level of maturity. And then the last thing that we look at, the highest level of maturity for decision support, is what might happen in the business and what are the levers that we have to influence those results. And FP&A forecasting, planning, and analytics is typically aligned with this category of decision support, helping management look forward, model scenarios, forecast revenue, cost of goods, forecast SG&A and operating expenses, sometimes resource planning, material planning, and purchasing planning, those sorts of things. All of those forward-looking decisions that management needs to make. What could happen in the business, and what happens if we make different decisions, right? All of these levels of decision support are really core to understanding whether finance is aligned with the strategy and whether it's helping drive the business strategy forward and ultimately driving profitability and value for the ownership. And what it requires is very high quality business data. And that data needs to be in systems. It needs to be in systems quickly with a high value of integrity and reliability. And you need to have the tools that can take that data and digest it without a lot of manual intervention in ways that align with the overall decision support requirements for management.
So the path to finance excellence, we see it as having 4 distinct steps. That includes assess, clean up, stabilize, and transform. And the reality is that the path to financial excellence is really outcome driven. We're cleaning up and stabilizing so that we can transform effectively. So we start out with an assessment, which is essentially the architecture that we'll need for the next few steps. A 360-degree understanding of where the entity has been, where it is, and where it wants to go, going back to what Steve just described as it relates to decision support. Then we get into cleanup. So when we look at historical information, really understanding that it's accurate and comparable for future evaluation purposes. The stabilization piece. So when we operate the entity, to make sure we do so efficiently and effectively to ensure we're minimizing costs and maximizing best practices, and eventually transforming, where we're using financial information to guide consistent strategic decision-making effectively. So one of the things that I wanted to share with everyone today is, as I mentioned before, one of my roles at the firm is corporate development and M&A. And, I find it very important as I'm going through the diligence process of reviewing other companies' financial information to understand both what's happening now, what happened in the past, so that we can see what's going to happen in the future. Because without that information, it makes it very difficult to really understand what we can eventually expect out of those businesses going forward. And really every step along this path is important to create accurate, well-organized, and meaningful information.
So as Jason just mentioned on the prior slide, it really starts off with this assessment and getting that 360-degree understanding of where the entity's been. And the way that we approach that is with a service called a rapid finance assessment. And this is really a complete look at the quality of a company's finance and accounting function. And even this is the way that we do it, but there's other flavors for this out there, and some CFOs do this on their own, right? But these kind of 6 areas are the main focuses of a good finance assessment. The first one is really looking at process and control maturity. Walking through the transactional processes, walking through the procedures and policies that govern those processes, and making sure that they're, understanding how efficient they are, understanding that if the correct key controls are in place, or at least a reasonable level of controls are in place, and defining the gaps in maturity that would bring the company from where they are now to where they're going. So, in this type of maturity model that you see here, the red would indicate the level of maturity that the company's at now, and the green dot would indicate what it would take to meet the qualities that are the goal, the end state goal for maturity. And most companies have, recommendations in each area of finance, and of course, some of them are more important than others. So going through this exercise helps you prioritize which processes to focus on first. Will help you identify any major controls gaps that should be filled immediately, and give a set of recommendations to move towards more of a leading practice finance and accounting function, but at a process level for procure to pay, for payables, for invoicing and collections, for the accrual process, month-end close, all that kind of stuff. What does it take to get from where we are now to where we want to be, and what are the qualities of where we want to be? You always want to understand how you compare to benchmarks. There are good quantitative cost benchmarks for what finance and accounting should cost. And there are certain ways that you need to categorize costs as to whether they should be attributable to finance or accounting or not. Understanding that is very important. And then also understanding at the end of this what the recommendations are, what that cost benchmark comparison would be, to understand how to structure the finance department from a staffing perspective, what are reasonable amounts of investment to make in new technology, and then where that would put you compared to the industry and other companies of your size. Systems and integrations is sort of an underlying aspect of all of these. So looking at the current systems, understanding how they integrate with each other. Most companies, before they do an assessment like this, have a lot of areas that are being managed on spreadsheets, sometimes offline databases, and there's people that are manually moving financial data between systems from paper to a system and those sorts of things. So a really complete look at the systems and the way that they interact will show all of the ways that finance data is being managed today, and help the team identify how that's potentially slowing the process down, resulting in weak controls, and preventing you from getting like really that great decision support that we talked through. Month-end close, you do the same assessment. Most companies have room to improve on a month-end close. If you're over a 10-day close right now, it's something that you should evaluate. This is a Gantt chart that will allow you to identify how those can be improved. The strategic alignment between the finance and accounting function and the overall company is very important, as well as the condition of the books, how high quality are the historical financials.
Yeah, and the assessment will really help us understand what we need out of the historical information, right? So the cleanup process is really key in recreating the financial history of an entity in a way that makes the future information both comparable and more useful. So some of the questions that we have to ask as we look at historical information is, how far back do we go? How much comparable information do we want? Do we want 1 year? Do we want 2 years, 3 years, 5 years, 10 years? And obviously, the more information that we want, the longer it takes. How detailed should we be with this information? Do we need it at the transactional level, the GL level, maybe at an account balance level? These are some of the questions that we need to start asking ourselves as we start to look back at our history. What is our eventual reporting output? So are we looking at monthly information? Are we looking at recreating annual information? Again, we're looking back in a way to recreate information that will help us make decisions in the future. Accrual versus cash, accounting standards. Are we on GAAP? Are we on IFRS? Has the company been managed on cash? So we need to make certain types of entries to get it to accrual, whether that's deferred revenue or accounts receivable, anything like that. How will technology enable or frustrate the process? Are we working with disparate systems? Maybe we have QuickBooks on one hand and NetSuite on another, where we're taking operational information from one system and financial information from another. How do we merge that together in a way that helps us get what we're looking for? How long do we have? Going back to what we were discussing earlier, if this is some sort of due diligence process and we're looking to close a transaction in the next month or two, we don't have a lot of time to perform this cleanup. So maybe that changes some of our answers to previous questions. If we're just looking to improve upon our strategy and our financial decision making, maybe we have some more time and we can go and look back even further in our history. And are there any complexities that may impact this work? This is something that we may not know right now. Things that come up throughout the process that we start to identify and understand, and maybe we look to start to change what's going to happen in the future in terms of how we start to operate the entity going forward. So stabilization, this is really the current operations of the business. We look at it in 3 different ways, though there are plenty of others that may come from it. So an internal stabilization or internal operation, this is basically your finance and accounting department in a traditional business. You have a controller or CFO, you have staff underneath them that you're training and you're developing, you implement key controls, you write certain reports, you expect some sort of 10 to 15 day close. Another option is a fully outsourced function. So this is a full stack finance team. It could be someone like a Citrin Cooperman who comes in, provides controller or CFO level oversight, flexible staff and team members that are indexed to transactional volume. So obviously, if there are a lot of transactions, we can assist with more of those needs. Reports that are specific based on needs, and then a shorter close process. And then obviously a hybrid of the two, where maybe there's an outsourced controller or CFO with some internal staff. Maybe there's an internal controller or CFO with outsourced staff. It really depends on the needs of the business and what's most cost effective. Key controls, key reports, 5 to 10 day close could come with that as well. Some things to consider as you start to make these decisions. What's the cost to build or buy? What kind of speed do you need in terms of close and financial information? What is the ability to retain people and capabilities? As we found, it's very hard to find good people, and getting best practices ingrained within your organization and developing those people to have those best practices is not always so simple. Management patience and priorities. What does management want? Do they want people sitting in their office every day, coming to work 5 days a week so that they can see them and understand what they're doing? Or are they willing to allow for an outsourced function where someone, is able to contact them via email or phone call? Now, some challenges, as we discussed, tight talent labor market right now. Very hard to find good people. Technology, how integrated that technology, various technologies are. We talked about, QuickBooks and NetSuite, and maybe there's a Bill.com and various treasury functions that are all linked together. And how do we fit those together most efficiently? What expectations an owner may have in terms of how its finance function operates, and then what capabilities does management have to really push everything forward and make decisions based on the financial information.
So after stabilization comes transformation. And why do we call it transformation? The reason is that the traditional way of looking at a technology project or improving a process or changing part of an org is limited in terms of the impact that it has. To really get the most and broadest impact to the finance and accounting group, you really want to attack all of those sort of at once. So when we think about transformation, you go through a process that scopes what the needs are, but then evaluates the org changes, evaluates the technology that needs to be implemented, evaluates the processes, and looks at those holistically. So for scoping, what you do is you look at logical groups of processes that just change together. So for example, you might subsect procure to pay or source to pay as a different transformation path than your order to cash processes. And you'll group those logical groups of processes within P2P and say, okay, it's reasonable for us to attack all of these processes at once. There are pieces of technology that we can use that are targeted at these processes, and we have people who we can, basically dedicate to making these changes for us, identifying the changes and making them for us. So after you have that scope of what you're going to transform first, you move on to those next 3 areas. You define how the organization needs to be structured, define what the management structure for those processes needs to be, and start identifying how you're going to move people around to fulfill those needs. You look at the technology, figure out how that's going to be changed. Can it be done in your core ERP system? Do you need separate technology for P2P? Jason just mentioned a couple of the tools, right? If you're in NetSuite, maybe you do most of your purchase orders, your invoicing, your matching within NetSuite. Maybe you need separate workflow tools or AP automation tools like a Bill.com or an AvidXchange. But you can make those decisions specific to the scope of the transformation. And then whenever you have technology and org decisions, you have to reevaluate your processes, and vice versa, frankly. So if you're going to be putting new P2P technology in place, to continue the example, you're going to want to look at all of those process flows, define and look at the process flows for your procure to pay area, and identify how they can be improved. So you're going to do a payables process flow. There's going to be a process flow for purchase order, for requisitions and purchase orders, for the approvals. And that's going to be matched up with the technology that needs to be changed and with the right roles and responsibilities for it. And that's all going to get packaged into a transformation initiative, right? So we would look at finance transformation broadly, which is probably a roadmap that has several groups of these projects in it. And then depending on the organization itself, the amount of bandwidth, the appetite for change, and how difficult everyone thinks it's going to be, you might package that finance transformation into a few different subsections of people, process, and technology changes. And the specific outcomes of that, if you're thinking of it from a deliverable standpoint, are organizational models, right? So this is an example of an organizational model that has aspects of local control, aspects of shared services, and then some areas where there's potential for outsourcing or third-party arrangements. And thinking through what that organization model will be in the future, and then how you're going to migrate into it is very important when you're scoping and planning a transformation initiative. You'll have process design. So this is an example of process flows. We do recommend going down to this level. Maybe not for every individual process, if only one person is doing it or something. But for the most part, getting a process on paper is going to allow you to understand, first thing, how effective the controls are, how to define the processes, and how it can be made more efficient or potentially automated. The system ecosystem design becomes very important. Understanding how systems communicate with each other, how transactions and data flow through each of those systems from, if you're a construction company, from the field into the core finance, into a consolidated set of financials, into other decision support tools for the ownership or shareholder group. And then your policies and procedures. A lot of companies don't have full accounting manuals or policies and procedures documented yet. During this sort of finance transformation, you're going to want to make sure that is an output. Every time you're transforming processes in an area, implementing new technology, or changing roles, you want to make sure that the documented policies and procedures with the right controls documentation is in place to support and govern those changes. Finally, what does that look like in terms of buying versus building? As Jason's going to talk about in a minute, there's good reasons to buy all those transformation capabilities, to buy the stabilization capabilities, and there's good reasons to build it internally. One of the big differences is the types of activities and in the time that's required, right? If you're going to go with an outsourced model or a hybrid model, you can typically condense the time frame that it takes to make changes and get to an operational state, because a lot of the decisions are already made for you. So the way that our outsourcing services work, including in a hybrid setting, is that we have an onboarding process that is a compressed and simplified version of a transformation, right? And then that onboarding leads into outsourcing, where you're moving directly from making the changes, getting the changes in tech and policies and procedures into place, into operations very quickly. It's generally the same group of people, so it's this sort of very seamless process. So if you do an assessment, if the rapid finance assessment and the outcome is we're going to have sort of this hybrid in-source outsource model, then you generally can move to that onboarding and outsourcing pretty quickly, within 6 to 8 weeks. Typically, everything will be up and running. You can also, for companies that want to do a full internal build, that is going to be a longer, more deliberate process. So there's going to be a design phase that has the elements that I just talked through. You're going to have to go through an implementation process of doing the hiring, implementing the systems, actually writing all the policies and procedures, which might otherwise come from your outsourcing provider. And then you're going to have to stabilize and implement that environment. So that all takes time, right? We're usually looking at those design phases usually are 8 to 12 weeks long, depending on how you scope them. And implementations vary depending on what you're doing. If you're implementing a solution for the close, where you're simply moving some roles and responsibilities around, getting new close documentation in place and maybe a management tool, that might be a 2-month project. If you have to do an ERP system, that could be a 6 to 12-month project. So that's going to really vary depending on the scope of it. But you got to do that assessment up front. If you do the assessment up front, you understand what the cost benefit is and the various capability trade-offs are between those two models. You'll be able to decide, can we do this fast and kind of in an outsourcing model? Do we have to take a little bit more time, build more specific capabilities, and own these functions internally?
Yep. So like Steve just said, there are multiple items to consider as we go through their make versus buy decision: control, cost, efficiency, talent, etc. And here we're showing 5 different options: build, buy, and then a few different types of hybrid options. But I figured I'd walk through hybrid 1, which is an outsourced controllership and below, outsourced FP&A, and an in-house CFO. Some of the pros here: a CFO gets to focus on strategy and decision support, can still get mature technology from an outsourcing provider. Cost savings are significant. There's less of an administrative burden, and it scales very easily. Some of the cons: no skills uplift or transferability because most of the people are outsourcing. Difficult for heavy customer service related businesses, again, because most of the people are outsourced in this function. And we feel this is best for businesses with high transactional volume. So again, this is a really good chart that helps describe some of the options that you should consider as you look to make or build, or even potentially hybrid options as you look to change what you already have.
I think the trend that we're seeing in the marketplace, especially with the way that finance and accounting talent is so compressed, is that these hybrid options are becoming more and more of a popular solution for clients. There's more leverage that you get with the technology that comes with it. It's easier to scale up and down as you need capabilities, or maybe you don't need certain things now, but are going to want them in 6 months. It's easier to move into those things, and it's less expensive typically. And also it kind of allows a best of both worlds, where you have some internal control, you can build the internal responsiveness that you need, and then you also get the skills and capabilities in the proportion that you require. So these tend to be a very appealing and cost-sensitive approach for a lot of companies, and including large companies. We're seeing this change where we've been working with multiple companies that are 9 figures, that even these hybrid options are really good solutions for. There are also really good solutions sometimes for smaller companies as well, who need a higher level finance person sometimes. And then for companies that have there's real value to having the internal capabilities, or there's just a shareholder preference, then they go the build option. And in which case you still do the same assessment, you still do the same roadmap, and then you've got full control over all of the technology decisions you make, all of the types of people that you want to bring in-house, and it's something that can build institutional knowledge and capabilities for the company. So the assessment's the best starting point, though. During a good assessment, you're going to look at all these options. You're going to see what the total cost of ownership of all of them would be. You're going to understand what the trade-offs in tech and processes would be, and management overhead. So it really all starts with having a really solid understanding of where you're at maturity-wise and where you want to go as a company. All right, so the first question is, Jason, I'll turn this over to you. What kinds of companies are going to need to perform a lot of cleanup on their books? When should a company really start to say, are my books in good shape? Do I really need to do some historical cleanup here?
Yeah, I think one of the reasons for a business to do so is if they're looking to transact, and if they're going to have whether it's a quality of earnings team, which would be a third party, or a buyer come in and really try to understand what happened to this company and what they're trying to accomplish. If they have their books and records and they're not in great shape, that's when there's a need for a company like ours to come in and clean up what's happened in the past, to again align the information with where that buyer potentially would want to go in the future, so that it can evaluate it properly.
Perfect. Yeah, I agree with that. Other question, we got a couple here. FP&A solutions typically hard to outsource. Are there good outsourcing options for it? Yeah, actually, there's very good outsourcing options for FP&A right now. And one of the reasons why it's smart is that good FP&A requires what's called a CPM solution, or performance management solution. Some companies can still do it on Excel, but most companies are complex enough where they really do need a piece of technology to manage it. The selection and implementation of that tech does take time and has a cost associated with it. And then you need the people internally who can really use it to its full potential. If you're a CFO and you need a better FP&A group, sometimes it is easier just to get a package of the people, the technology, and some of those frameworks, the enterprise models that it takes to run a good FP&A function. That said, building it, if you can get good FP&A people, or it's important for you to, then building it is certainly an option as well. We help companies with that all the time. How do you, just building a leading class FP&A function internally. All right, recommendations for ERP or accounting software. Somebody graduating from QuickBooks. Question we grapple with weekly with new clients. Jason and I probably both have perspectives on this. I would say that the next step after QuickBooks is going to depend on how fast you're growing and what you want to do with the company. If it's going to continue to be privately held and it's a slow linear, not slow, but a linear growth company, which a lot of like traditional family run companies are, moving into either an industry specific solution or a tier 2 ERP solution is generally going to be the right move, and doing so in limited scope. So going to a NetSuite or an Intact, or if you're like a manufacturer, maybe you look at Cloud Suite Industrial from Infor and Epicor, Microsoft Dynamics, something along those lines are good viable options. When we're looking at QuickBooks migrations, we generally have somewhere in the area of 3 to 5 shortlisted viable ERP options for them to move to. We do recommend a formal selection, even for smaller companies, because it's a pretty big project. It's always costs a lot more than QuickBooks, and you want to make sure you make the right decision on the ERP package to move into. The other thing is that there's a big difference between using it just for something that you're going to use just for accounting and finance, and something that you're also going to use for operations. Because a lot of these systems start to integrate, if you're a manufacturer, there's, all of your ops. There's your manufacturing execution, your costing, your inventory management. If you're a professional services company, you've got resource management, project management. Construction companies have their own requirements. So there's actually a lot more optionality there than it may look. You definitely want to make sure that the package is going to be capable of the reporting and accounting capture that you have. So if it's a project-based business, you're going to need a project-based accounting package. They're not all project-based. If it's not, and you need really good inventory capabilities, they're not all capable of really good inventory management. So a little bit of a broader answer. I mentioned some of the packages that we often see, but there's actually a lot more. And we always recommend at least a short structured selection process. Jason, what typical daily hours of an accounting department? Do we have any benchmarks off the top of our head on that, or do we could definitely get back to this, the person who asked this with the answer.
Yeah, I would say we're to speak specifically, we'd want to get back with some specific information on that. I don't know off the top of my head what that would be.
Okay. Yeah, I think the lowest we've seen is probably in that 60 to 80 hours a month range, 40 to 60 a month range, but it goes up pretty dramatically as well. And a lot of it depends on how much reporting you want and transactional volume. We have a whole model that we use to estimate what expected hours are. So always happy to talk about how to run that model for your company. So we're a few minutes over. Jason, thanks for joining me today. It was fun.
Thanks for having me, Steve.
As always. Emily, who's the winner of today's snack basket?
Okay, today's winner is Bruno Walmsley of Van Wagner Group. Bruno, I will be in touch for your information.
Congrats, Bruno. We've been getting great reviews on this snack basket, so we hope you enjoy one of our last two before the summer. So this is our second to last session before the summer. We're going to wrap up next week with Mandeep Trivedi, who leads Citrin Cooperman's valuation practice. That's going to focus on the value of intellectual property, how to look at it, how to calculate it, what to use that value for. Although we're not going to be running new sessions throughout the summer, we will be rebroadcasting some of our past sessions. And as always, you can always go back and watch the videos and the decks on our website. I'd like to thank everybody for joining us today. For those of you who have joined prior sessions, I'd like to thank you as well. The video from today, the deck from today will be posted on our C-Suite Snacks Hub within about 2 business days. And you'll get an email reminding you that that's been posted. So it's great to see everybody. We hope to see you next week. And if we don't, hope you have a wonderful summer. We will restart everything in September with a brand new set of weekly webinars and master snack sessions. Have a great day, a great summer, and take care as always.